Right, so welcome. I know I'm, standing between you and coffee. Well, actually, I was standing between you and coffee, and I hope you're all, well caffeinated now. So what I want to talk about, I want to start from a rather simple but, a bit controversial premise: the fact that regulation and innovation are sitting at the opposite sides of the table. And what I'm contending is that this is not the case, that they should be and that they are sitting at the same side of the table. There has been a lot of conversation about whether regulators need to be proactive, and we spoke about anticipatory regulation. But what I want to make the case for is participatory regulation, in the sense of achieving the best results through a set of technologies that may go under the banner of blockchain, and that will allow this sort of additional affordances for collaboration between FinTechs on the one hand, and I'm just focusing that on the FinTech industry, FinTechs on the one hand and the regulators on the other. So what the case I'm actually making and what I want to talk about. So I'm going to start by discussing a bit about the nature of compliance, because I think it's important that we understand what compliance is about and how compliance materializes, and then look at a bit on in the world of decentralized finance, a set of affordances again, and you will hear me using that term a lot, that allows, has created a new industry, that of, decentralized finance services, and then from there used the anti-money laundering KYC case for regulation, which is quite a heavy one and one that keeps people awake, very much, to make the case for what I opened up with, which is how we can use blockchain to and this decentralized governance, and that's where I want to focus, decentralized governance to achieve that collective intelligence. And just to make the definition of what I mean by collective intelligence is, the way that it's being used in the context of this talk is the capability, the superior capability created on a network of participants, which capability cannot be achieved by each one of the participants individually. So in a way, materialization of a network effect. So where I want to start from as a motivation is, that's probably one of my, and many of you will recognize this, confusion matrix. I'll start from the case of regulation compliance, and I use again the example of anti-money laundering as a data problem. And the reason I'm making this case is precisely because it kind of draws a very clear line between where we want to be, which is the left-hand side, and where we are moving, or we're trying to move away from, which is the right-hand side. And what you see is that very interesting arrow there called cost. The other thing that I need to stress is that if we talk about money laundering, for instance, or if we talk about fraud, that contention between the unidentified fraudulent transactions, money laundering, or whatever you can call it, economic crime, and the genuine, which are identified falsely, are these points of contention that create that balance between, or imbalance is a better term, between compliance risk and business risk. And if we think of compliance, I think it's fair to say that full compliance is a deterministic notion, which, however, is defined around non-deterministic terms. Deterministic in the sense that we know how to achieve full compliance, but by means of the fact that there is a set of rules that if we follow, we are fully compliant, but the way that these rules are defined are not precise. So the definition, for instance, of what it means for a company to be fully capable of identifying the false positives and false negatives is non-deterministic. It's a lot more, probabilistic. And so this is that, I think, starting from that point of contention is important. So there is that element of compliance cost that comes into play, and precisely the realization that you cannot be entirely compliant. And the regulator has quite, a difficult job. Now, I'm jumping away for a bit from this, notion of compliance, and I'm going into blockchain. And the reason I'm using this title, it's a title I used in one of my previous, blockchain talks, Democratizing Arbitrage, which it's an entertaining title which I borrowed from Terra's protocol when it launched Luna, its platform. And it makes the point of how blockchain creates this sort of new space where previously unpopularized or elements or actions which were previously only done by the big players can now be afforded by even the individual. And one example of that is the ability of flash loans. For those of you who are familiar with this decentralized finance applications of flash loans, a flash loan is an atomic activity that will allow any individual or anyone with the processing power and the funds to loan a significant amount of money that they would not be able to to borrow in other terms, perform potentially heavy arbitrage across different markets, across decentralized exchanges, and return that money. Now, this is not possible with fiat money, but it is possible through decentralized money, through cryptocurrencies and through the platforms on which they sit. Why? Because the way that these platforms are set and the atomic nature of these transactions allows you to, without bearing any risk at all, to borrow the money, perform the action that you need to perform, and if you fail, the money is being returned back and nobody gets hurt. So this is one example of how decentralized finance changes the landscape. So it kind of changes our behavior. It also changes our understanding of value. It's interesting. I mean, I always enjoy Gartner and these hype cycles, and I think this is quite. And I know you can't read that, but I will read what's important out of it for you. Looking at 3 versions of the hype cycle, not fully synchronized. Emerging DeFi, many of the terms you'll see on that when I share the slides, I don't even understand because some of them are just, some trends. Hype cycle for emerging technologies 2021, hype cycle for blockchain 2021. What we see is that in different, areas of that cycle which are quite close to each other, we have these 3 observations, these 3 following things. Tokenization becomes more rationalized, so the ability through decentralized applications to tokenize and assetize, which is what I'm going to talk about right after. The uses of smart contracts becomes a lot more pragmatic. And again, for any of you who don't know much about smart contracts, think of smart contracts as decentralized applications of legal contracts, which, however, are automatically executed. A series of if-then-else statements that allows an action to be performed, a payment to be performed, for example, upon meeting certain conditions. So in that, the idea of smart contracts, of course, is a lot wider and has a much, broader implementation, but this is, one of its primitive and its primary uses. And the other one is that decentralized applications start to achieve more mainstream focus. So they are not anymore experimental. We see real use cases. Blockchain is not anymore, as it used to be maybe 2 or 3 years ago, a solution looking for a problem. It is it provides a robust set of use cases that are visible. So hype cycle tells us that there is some maturity coming up. And again, unpacking this, the nature of this decentralized finance and fintech environment, I want to make, 2 main observations. The one is that concept of assetization, assetizing value. And think of the and I think, you know, I had a conversation during the break with some of you. We're talking about NFTs. Think about, you know, non-fungible tokens and the fact that non-fungible tokens are now seen as, well, one thing that has quite, you know, ridiculous use cases. So, you know, somebody tokenizes their, you know, picture, or, you know, celebrities are using this, and these go in the market for exorbitant amounts of money. But on the other hand, think of the capability that this introduces. If we think of how, for example, you know, decentralized applications like initial coin offerings, initial exchange offerings, and so on, or stable coin offerings and so on, have started this market, that affords the ability to put a value on the internet and can communicate, transact with this value for anything. Whatever you want, you can assetize it. You can turn it into an asset. And that actually has, you know, will have, I believe, a significant, you know, set of use cases in the future. Think of any sort of asset that can be tokenized in that sense and be rented or sold, or create in many different ways new streams of rents, new streams of income, new streams of value. So essentially, decentralized finance creates a new layer of applications and a new layer of revenue models on top of what we already have. It's not just the, you know, metaverse applications. You will find that there will be a lot of more, well, substantial, if you like, you know, applications that not only relate to, you know, the virtual assets, but also to virtualizing real assets. So, you know, NFTs are a core case there. And tokenization is what I also talked about, and that has created new players. And the reason I'm bringing up all these new players is that all these new players will have to be regulated somehow. Somebody will have to regulate them. So we have new actors, token issuers, custodial services, the so-called Oracle operators, the technological platforms that allow different blockchain technologies to talk to each other, which will allow blockchains to be layered one on top of the other, and so on. And also there is what we call embedded finance. So in that sense of, you know, experience as a service. If you think of it, that kind of creates a new anything as a service type of layer. So experience as a service is something that will, allows, you know, to translate a customer experience into transaction. One favorite example is that of, say, for example, you know, getting an Uber. That is a transaction, but you don't see the finance behind it. You buy the experience. You don't buy, you know, the way of a payment. The way of payment is supposed to be transparent. And all these abilities, and I'm taking you back to smart contracts, which allow these abilities to be as flexible as can be, implement that sort of affordance. And as I mentioned here, is that the decentralized finance advantage, the DeFi advantage is precisely that the actual atomic transactions via smart contracts. And when I say actual, that is one of the it underlies one of the fundamental differences between fiat currency transactions and cryptocurrency transactions, or anything on a blockchain, that any transaction that takes place on a blockchain is actual. So when I am sending you Bitcoin, there is no clearing process. Whereas if I'm sending you, you know, dollars or pounds, there will be a clearing house, there will be a clearing process behind. Cryptocurrency transactions are, you know, direct, are atomic, and, you know, they do not need that intermediate layer. Now, why am I mentioning all that? I'm mentioning all that because that kind of, again, contributes to how that new landscape is being built. It's a brave new world in a way, and one that calls for regulation. So what we also have in the fintech space is that, and if you think of it with the API economy, open banking, and so on, you have an ecosystem that is much more granular. So you have a lot, more services. So you have a disaggregated supply chain and disaggregated value chain as well. You have more services, potentially better services, and I say more and better because there is a lot more specialization. You have agents, organizations that deal with KYC only, AML only, identity verification only, and so on. And that is, that is wonderful on the one hand, and on the other, it creates, a lot more space for innovation, but also abuse. So we have that re-intermediation, but also the need for re-regulation. I like this one from Ernst & Young because it kind of, epitomized very much of what I'm saying. And where it ends, where it leads actually, if we look into that model, is that dedicated re-intermediation. We have this, services around know your customer, source of wealth identification, AML, CDD, and so on. And at the end of the day, you have this knowledge as a service, and anything as a service, banking as a service, cards as a service, white labeling of products, and in essence, insights as a service become quite important there. And again, smart contract use cases are in abundance. Most of them are in the world of cryptocurrencies, but not only. So what I wanted to just draw on for a bit and going into that need for developing collective intelligence, I will start from just making the case along the lines. I had to pick a case. I have to pick a use case, so I'm picking the case of anti-money laundering, which is also very close to my research. That's what I do. So if we look at money laundering, and if we consider this granular ecosystem, as I mentioned before, we all know money laundering is about placement, layering, integration, if we want to use that, that kind of operational framework. And on the one hand, in placement, you have all these, different capabilities. You have all these different service providers. You have external sources that can be used. You have a number of technologies that can be used, and you have certain fintech support services which are business saving. If we look at it from the layering point of view, there is even more. So if you think of that as a business model, and of course, in integration, you have yet another layer of activity on behalf of the money launderer. So money laundering itself is a business model, and we have to identify, to recognize that as a business model. These people are doing a certain business. But how do we jump from that to anti-money laundering? And this is where I get to this, collective intelligence. So let me run this by you. The fact that when you are looking into anti-money laundering solutions, and we're talking from the regulator's point of view, we have different vendor solutions that will allow your bank or your financial institution, your PSP, your MSB, to look to actually review the transactions that concern themselves. So you can see just arm's length reach towards the outside world. But what if you are able to have a congregated capability that will allow many banks, just, I'm using the, traditional marble pillars representation of banks. Let's assume an ecosystem with 3 banks. What if these 3 can anonymize their data? They can, congregate around this collective intelligence hub, develop that collective intelligence, which is that superior knowledge, and feed it back to the members. That's one. But again, that is something that has been I personally have proposed it in the past and has been tried and tested, and we all know in this room how difficult it is to share data and actually draw on that intelligence. So where the the decentralized governance, and I say decentralized programmable governance, comes into play, is where you get to utilize the the smart contract application, where all these three banks that were previously sharing their data communicate through smart contracts and interfere, and what interferes between them is a collective, a governance layer that allows for some sort of, federated consensus policy. So in that sense, allowing each one of the banks to become participants to the regulation process themselves. And the reason I'm saying that as an idea is not something that is very radical, but as a technological platform, this is something that we never had the capability to do before. And all indications are that now we are able to do that. So that allows programmable governance. You are able to bring in the participants, the FinTechs, the banks themselves, into not only deciding how they share their information, but also build on top of a collective intelligence utility a number of additional layers that will allow for that utility to be then augmented. So in a way, going back to some of the points that were already made about the role of regulator, allow a utility model that is accessible to all on the one hand, but on the other hand, not stifle innovation. Allow companies to innovate on top of that. So use a basic level of collective intelligence, of knowledge, of knowledge discovery through a utility model that can be funded and supported by all the participating actors, but allow us to augment on that. So the affordances there are cross interoperability, an agnostic approach to local infrastructure, so not so much technology dependent, and that governance layer is actually what makes the real difference. That it allows shared, shared contribution, shared governance, and this is just to stress the the role of the complexity of the role of the regulator, and just to go to the final points I wanted to make, which have to do with the way that the regulator's role potentially is being transformed. So we have new affordances of decentralized finance, which promise new innovation, but also create new problems. We have new markets. As I said, I talked about assetization, and I believe a slow change in how we perceive value and how, I'm expecting that we will see this change in our perception of value quite soon. And at the same time, we are entering a new governance paradigm. We have much more democratized structures, and I use this term, democratized structures, in the sense that the decentralized nature of blockchain-based solutions allows for this shared contribution of different actors into, defining the regulatory framework itself. So what that calls for is more of a participatory model of regulation, where the FinTechs, the actors, become actors themselves. They are not passive recipients of regulation. The regulator and the participant, the other actors, the FinTech, are sitting on the same side of the table, and in that way, innovation is not being stifled. So we have a lot of reliance, of course, on democratized incentives, and there is a lot of discussion about, okay, there is a lot of discussion about how, for instance, all these consensus approaches in blockchains really work, and what are the limits of agreement and how these will work. And there are other technological questions, like what happens with the prevalences of things like quantum computing. Will all blockchains be all of a sudden broken? Now, these are more granular technological questions to be answered, but pending an answer to all these, I think we are in a good route to deliver that decentralized governance in in regulation, and therefore allow this collective intelligence to take place. And this is actually everything I wanted to talk about. I hope I didn't go over time. And do you have any questions?
Yeah, any questions?